Global Finance Capital Budgeting Lab, copyright Lou Gaddis. In this lab, we're going to look at calculating an NPV of an investment in a foreign country. So we're going to go from foreign subsidiary cash flows to parent US dollar cash flows, calculate net present value, and perform a sensitivity analysis using a data table and at risk. We're going to use free cash flows to the firm. Free cash flows of the firm are cash flows available to both bond and equity holders. Interest payments are not subtracted, but taxes are subtracted, and non-cash items are added back like depreciation, and CapEx is subtracted. We're going to use a shortcut method for calculating free cash flows. That'll be revenues times operating profit margin. That'll give me operating profits. Subtract out taxes. And then I'm going to subtract something called net reinvestment. Net reinvestment combines CapEx, working capital, and depreciation. The example is Panera Bread is considering launching a chain of drive-through espresso kiosks. They plan to open 50 stores in the Vancouver area. Each store will generate 850,000 Canadian dollars per year, and they will cost $500,000 today. Revenues will grow up 5% for 5 years, and then 3% in year 6. When calculating the terminal value, the enterprise is worth 5 times free cash flows in year 6. So if I take these assumptions and move them to Excel, I have free cash flows. This is all in thousands. And the initial free cash flow, so free cash flow in year 0 is 500,000 Canadian. 50 stores, 850,000 Canadian per store. Revenue growth years 2 through 5 and 6, operating profit margin, and then net reinvestment, tax rate, and free cash flow multiple. I'm going to go for years 0, 1, 2, 3, 4, 5, and 6. So we're going to start off by calculating subsidiary revenues in Canadian dollars. So in year 1, I'm going to generate 850,000 per store times 50 stores. Those revenues will then grow by 5%. I'll anchor the 5%. Copy across. Then I'll calculate operating profits. Which is going to be the revenue times the operating profit margin. I'll anchor profit margin percent. I'll calculate earnings after tax, but before interest. That'll be my earnings before tax, operating profit, times 1 minus the tax rate. I'm going to anchor that tax rate. I'll calculate net reinvestment. Net reinvestment is going to be a percentage of sales. So I'll take revenue times my net reinvestment rate, 5%. I'll anchor that, 5%. And then I'll get free cash flows. We'll call that subsidiary free cash flows, which will be earnings minus net reinvestment. And the first year, I'll go ahead and just capture the cost per store times 50 stores. So there are the subsidiary free cash flows in Canadian dollars. Now what we're going to do is make a bunch of adjustments to get to parent free cash flows. And those adjustments we're going to look at are sales creation, sales cannibalization, incremental overhead costs and transfers, market value of any resources used, and then we'll deal with repatriation taxes. We'll then get parent free cash flows, convert it to dollars, and then take an NPV at the WACC. Cannibalization are a loss in sales or profits due to a new business line. So the example that's commonly used is Coke Zero versus Diet Coke, that if I was going to perform a NPV on Coke Zero launch, I'd have to subtract out the lost sales in Diet Coke. And the same thing for an iPad versus a mini iPad. The opposite of cannibalization is sales creation. In this case, you increase your sales in other products by launching a different product. For example, when the iPod was initially launched, sales of Apple computers surged. So that's an example of sales creation. Then we'll subtract the market value of any incremental parent resources that are used. So in the project you'll see shortly, some vacant office buildings are going to be used by the new subsidiary. Those buildings could have been sold, so we want to make sure we subtract any incremental resources that are used by the subsidiary, even if they're not charged anything. What we don't want to subtract are any overhead costs that are allocated. For example, an allocated cost of the CEO's salary. So in this example, Panera estimates there's going to be 10 million of cannibalized sales due to the loss of business at the main stores. However, they will create some additional sales as customers that maybe try the coffee for the first time then go to the main stores. So we have 10 million in cannibalization is lost, but 8 million is sales creation. Panera is also going to hire 3 people today to handle the new enterprise. There's going to cost a total of 600,000 Canadian. And also, Panera will allocate overhead costs of 1 million Canadian dollars for existing headquarters staff. We're going to ignore that in the NPV. Lastly, the parent is going to allow the subsidiary to use office building space that could have been sold for 3.3 million Canadian. That has a book value of only 100K. So you want to make sure that we capture the market value and not the book value. So let's go ahead and incorporate those. So we got cannibalization, sales creation, corporate overhead, and that corporate office. We'll assume all this happens in 1 year. So cannibalization costs 10,000, creates sales of 8,000, lose 600 for the incremental cost of new staff hired, and we're going to subtract the market value of that initial building. The first 3 costs will continue annually. And this was a one-time shot. So now we have parent free cash flows. So I'm going to sum up these numbers. So now we have parent free cash flows in Canadian dollars, but before repatriation taxes. So the next assumption we're going to make is that there's going to be a repatriation tax of 10% on repatriated earnings or free cash flows. We're then going to convert all those cash flows back to dollar using the spot price of the Canadian dollar of $1.1233, and then we'll use interest rate parity to forecast the exchange rates for the next 6 years, and then we'll discount everything back at 12% WACC. So let's write down some of those assumptions. We have repatriation tax of 10%, the spot price of the CAD, $1.1233, the risk-free rate in the US, 2%, risk-free rate Canadian is 6%, and the WACC is 12%. I'm going to change these using a home cell style of input. So now we can calculate parent free cash flows after repat. The first year, since this is a cost, we don't put a tax on that. But then at the end of the first year, we're not going to be able to keep all 815. We're going to have to subtract the repatriation tax. I'll anchor that. Now we have total Canadian dollars available to send back home, but we're going to convert that to US dollar. So I want to get the CAD USD exchange rate. We said the spot price is $1.1233. And then I'm going to use interest rate parity to forecast the exchange rate for the next 6 years. So it's the spot price times 1 plus US interest rates divided by 1 plus Canadian interest rates. And I'm going to anchor those two interest rates. And then forecast the exchange rate for the next 6 years. And what you notice is the Canadian dollar is devaluing because they have higher interest rates and presumably higher inflation. And now we can convert everything to parent free cash flows in USD. So I can just take the Canadian dollar cash flows times the spot price of the Canadian, and then convert and get US dollar cash flows. And then we'll calculate the present value in USD by discounting all these cash flows at 12%. So I'll take the cash flow divided by 1 plus the WACC. I'll anchor that. Except in the last year, I had to make one adjustment. This one has a terminal value equal to 5 times free cash flows. So I'll take the final cash flow and multiply times the free cash flow multiple. Make sure you don't type in 5 here and you type in the reference to the cell, because we're going to change that later. And now you have the present value of all cash flows. I can calculate an NPV by summing all those. Oops, I didn't take those to the T power, so let's go back there. So let's 1 plus WACC raised to the 0 power. Now I can copy that across. And then again, I take that last cash flow and multiply times 5. But make sure you use the reference. Okay, so now we have the NPV. Let me do a couple formatting changes here. I want to highlight where I inputted a value. Home, format, cell styles, input, and then all the rest were calculations. And then I'm going to highlight this number here because that's the one we're looking for. Cell style, accent. So there's our NPV. Now we're going to do a little sensitivity analysis using a data table. So we're going to do a data table by first just making a reference to the NPV. And then we're going to look at different levels of free cash flow multiple. So let's say the free cash flow multiple could be 1, 3, 5, 7, or 9. And let's say we'll also look at sensitivity to the WACC. And let's say the WACC could be 6%, 8%. Change the formats there. And we'll go up to 18%. Alright, so now I have my variables. I'm going to look at WACC from 6 to 18%. I'm sorry, we'll go to 20. And we'll look at free cash flow multiples from 1 to 9. And what we do is we want to get a series of free cash or NPVs. So what we do is highlight this whole area. Data. What if. Data table. It asks for a row index. That's the free cash flow multiple. You reference the cell that has free cash flow multiple. And then the WACC is the column. So I'll do the cell that has the WACC and hit OK. I'll change the formatting a little bit to dollars. So these are NPVs. Notice this is my base case NPV here. That's when the free cash multiple is 5 and the WACC is 12. The NPV is negative 3.3. I like to change colors on this so make it look a little bit easier. Let's go home, conditional formatting, color scales, and I'll put that in. So you can see that the most favorable conditions are when your WACC is low and your free cash flow multiple is high. And this is your boundary between positive and negative NPVs. So this is a common way to do sensitivity analysis of two variables. And the last thing we're going to do is use at risk. So I've already launched at risk. And I'm just going to pick 3 variables, which are kind of easy to access just to show you. Another way to do sensitivity analysis is look at other variables that could have different values, make some assumptions on the distribution, and run a simulation. So let's say the 2 interest rates, US and Canadian, and the WACC, say those are 3 variables we want to see some sensitivity analysis around, or see how sensitive the NPVs are. And let's assume that US interest rates are normally distributed with a standard deviation equal to 2%. Canadian are normally distributed with a standard deviation equal to 4%. And we'll say the WACC has a triangular distribution with a min of 5, a most likely value of 12%, and a max of, we'll say 18%. So we're going to input these as 3 inputs to at risk. Our output will be NPV, and we'll run a simulation and see the probability that the NPV is positive given these 3 variables. So I'm going to click on US interest rate, at risk, define distribution, select normal. Under standard deviation, sigma, put in the 2% standard deviation and hit OK. Under the CAD, at risk, define distribution, normal, and let's put in a 4% standard deviation. And then for the WACC, we'll select the WACC, at risk, define distribution, triangular. Now triangular distribution looks a little bit like normal, where it has a single peak, but in this case the min and max values are truncated and the peak is pointy. So we'll have to define some of those points. We'll say the min is 5%, most likely 12%, that's my peak, and then the max is 18%. So instead of sampling from a normal distribution, it's going to sample that the lowest is 5, the highest is 18, and the most likely is 12. And then we'll come down here to our NPV calculation, at risk, add output. And now we can run an at-risk simulation of, say, 10,000 iterations, and we'll start. So these are our 10,000 NPVs being calculated. We will then calculate, say, the 5% worst, 5% highest, and then lastly I'll look at, say, the probability that the NPV is positive. Okay, so now our 5% lowest NPV is -10. Our highest is 9. But if we're also looking to get, say, the probability that the project is good, positive NPV, I could slide this over, make this 0, and see that it's only a 30% chance that this project has a positive NPV. I can then right-click on the graph, copy it, close, and I can just paste it in here for some additional analysis. And that's what's going to be due for this assignment. You're going to make a small change in the NPV calculations. You're going to calculate a new data table and rerun the simulation. And the change you're going to make is you're not going to use the free cash flow multiple of 5, which is built into this formula down here. Okay, so in here is my formula for free cash flow multiple. What you're going to do is you're going to take that out, and then you're going to change the spreadsheet that it's not going to use a free cash flow multiple. It's going to use a perpetual growth rate of 3%. Do a constant growth perpetuity calculation. Once you do that, change the formulas so it does a perpetuity formula and not a free cash flow multiple. Change the data table that it doesn't look at different levels of free cash flow multiple. Change it to calculate NPV using perpetual growth rates of 1, 2, 3, 4, and 5%. Get the new data table. And then just rerun the at-risk simulation with 10,000 iterations. Copy the graph again. And then you'll print something out that looks like this, except it's going to have the new values. And that's all it's going to be due for this assignment. There's going to be 1 assignment per person. So that's an example of using Excel, data tables, and at-risk to calculate capital budgeting NPVs for foreign investment.